Okay, welcome back, everyone. And I just also wanted to acknowledge Mrs. G re-election and still on the board. So, yeah, okay. Our next session is a discussion about the regulatory landscape featuring Commissioner Jackson from the U.S. Securities and Exchange Commission. And as Marcy noted, Commissioner Jackson couldn't be here in person today because of the government shutdown. So he's joining us via WebEx from Washington, D.C. So Ben, would you please get us started?
Yes. Thank you, Mr. Jones. It's now my pleasure to introduce Commissioner Robert Jackson Jr., who was appointed to the Security and Exchange Commission by the President of the United States and received unanimous approval by the Senate Banking Committee and unanimous confirmation by the United States Senate. He is currently on leave from NYU School of Law, where he is a professor of law. Before joining NYU, he was professor of law at Columbia University and director of the program. So for those of you who read his bio, he holds multiple degrees, total 5, and all from UPenn and Harvard. So the challenge, as Marcy and Henry just noticed, that the challenge of the current federal government shutdown almost prevented us from his presentation. But with a little bit of technological application and help from our IT department, we are able to have Commissioner Jackson join us via Skype. So please join me in welcoming Commissioner Jackson.
Well, thank you so much for that very kind introduction and for the opportunity to be with you all today. It is my great pleasure to have the opportunity to talk to all of you who are responsible for retirement, investments, and savings of so many millions of Americans. And I want to begin by apologizing that I couldn't be there with you in person. I have over the years worked with CalPERS on a number of initiatives, and I was looking very much forward to seeing some friends, old and new, but I'm sure you can understand, given the shutdown, that it was better for me to speak with you remotely. Nevertheless, I look forward to seeing you all in person sometime soon. And in the meantime, I thought I would briefly share some thoughts about the work that you all have been doing on policy issues that are important to us at the SEC at the federal level, and to take some questions from you about that work and what the likely path forward is here at the SEC. So with your permission, I'll offer a few brief introductory remarks, no more than a few minutes, and then I'll open it up to questions. Does that sound okay?
Yes.
Terrific. Thanks so much. And again, I'm sorry that I can't be with you there in person, but this was an important enough message that I wanted to be sure I sent it today. And let me start by saying how important you all and this organization's advocacy have been to improving the outlook for long-term, buy and hold, ordinary American investors and families, and the difference that is making to their long-term retirement security. And I want to say something just for starters, which is there are a lot of subjects I'd be happy to talk about with you today, and some of them have taken on a partisan valence. Sometimes my colleagues and I on the commission disagree or agree, but I'm going to highlight 3 areas in which this organization's advocacy has done so much to protect not only California's retirees and families, but those around the nation. And without it, frankly, those steps would not have been taken. So let me give you 3 examples of areas where this organization's advocacy has been so important to protecting investors. And the first and most obvious area is on market structure. I'm not sure whether you'll have covered this in detail yet today or whether those sessions might still be coming. But as you all might know, for years, the major U.S. stock exchanges have been increasing the cost of investors to trade on our stock market. Now, I should back up and make clear that over the years, the cost of buying and selling shares actually seems to have fallen, and in many ways it has. But in others, the structure of our stock markets continues to extract fees from American investors in a way that really endangers their long-term retirement security. And let me give you an example of what I mean. Right now in the United States, we have 13 public stock exchanges. And that makes it sound like you have a lot of competition over the business of buying and selling stocks. But that's true only until you notice that of those 13, 12 are owned by just 3 corporate conglomerates. And what those conglomerates have been doing year after year is increasing the price of stock market data, of connecting to stock markets, and of buying and selling shares on American stock exchanges. And they've been doing that because it creates a business model that many would refer to as high-frequency trading. That's a business model that's very profitable for folks in New York and very good for people who make their living investing. But for the ordinary Americans who make their living any other way, it has been a disaster because they are continuing to pay fees far exceeding the costs of the actual services they're getting on stock markets, and those fees add up. And here's the thing I want to say to you, and I know all of you sitting around this table understand this better than almost anybody in America. Small fees withdrawn bit by bit from retiree savings. Every time they put money away, every time you all at CalPERS go to buy a share of stock, taking just a little bit away, that adds up. And it makes a difference in how soon people can retire, how soon they can send their kids to school, and the way they look at their economic future. And CalPERS has been a leader. In fact, I dare say the leader in getting us at the SEC to confront the increasing cost of trading stocks in this country. And I'm very pleased and very proud to say that just in the last 3 or 4 months, we have unanimously, this is a bipartisan issue, agreed to stop the stock exchanges from increasing certain fees on investors, to run a new experiment to show how stock exchanges payments to bring certain trading to or their exchange or somewhere else are harming investors or affecting investors. And we're going to continue down this path, and I'm here to tell you that without CalPERS' work and advocacy, we would never have gotten that far. And I want to tell you why. As you all know, there is no easier way to extract money from the American people than to do it a little bit at a time. And you all know very well that doing it that way is a way to get other people to pay attention to something else and also to earn a lot of money over a very little bit of time. And that's what was happening on our stock exchanges until these last 18 months. And I'm very proud to say that we, as a commission, on a bipartisan basis, have moved forward with these steps. And we've done it because institutional investors, like all of you, have come to the table to tell us what's hurting American investors. And you've been getting us to focus on that issue in a way we never had before. I'd be happy to talk more about this in the Q&A, but for now, I just want to say your work has been absolutely critical to us moving that ball forward and protecting long-term investors. And that's my favorite example, because it's an example of a situation where for too long we were favoring high-speed, minute-by-minute investors, and you all have got us thinking about the long-term health of our economy and our country, and that's where our focus should be. So that's first. Second, in the area of corporate governance, and especially executive compensation, you all have been such an important leader in preparing our companies for the long-term future of this country. And I want to say a few things about that, but the focus for present purposes should be that when it came time to take steps to reform executive pay, to make sure that American managers had incentives to maximize over the long run the interest of the company, when it came time to remind executives that they shouldn't be favoring a short-term stock pop, but instead should be increasing value for everybody at the company over a longer period of time, you all stepped up in a very significant way and helped both the Congress and the Commission take steps that made an enormous difference in the way that we think about how to give people incentives to run companies for the long term. And again, this is a very good area to point out that your advocacy has aligned with the people that you work for. Because you don't have day-to-day traders. You're not trying to protect people from what a company's stock price might be tomorrow. You're trying to protect their futures and make sure that the companies they work for and own and invest in are managed for the long run. And changes that have been made to executive pay rules here at the SEC have played an important role in that work, and I'm very proud to have been a part of it, and I'm happy to talk more about CalPERS' role in that area as well. And then finally, I want to emphasize one more area in investor protection where you all have done just extraordinary work in making sure that we have our eye on the ball. And it's got to do with certain kinds of financial products that are being sold to American investors in a way that doesn't make sense for those who are saving for the long term. I could give you a whole bunch of examples, but the easiest one is the famous leveraged or geared ETF, where an investor is invited to buy a fund or invest in a fund that produces a multiple of a particular index's investment returns. And I, with the support of your terrific team who have focused me on this issue, have begun to speak out about them, because these financial products are bad for investors to hold over the long term. Indeed, the people who sell them tell us that they're bad for people to hold in the long term, but the evidence makes clear that a lot of investors, including, I imagine, some investors who are also protected by CalPERS, get to the time of their retirement and have the following moment. They say, I'm behind on my savings. I don't need to get the S&P 500. I need to get 3 times the S&P 500. And so they buy a product that makes that promise, and the day-to-day volatility of the stock market erodes their investment day by day, until they open that envelope 10 years later, ready to pay for someone's education or ready to retire, and they've lost half or more of their investment. And I have been fighting here at the SEC to make sure that investors understand the difference between a long-term investment, like the ones CalPERS makes, and the near-term financial products that really aren't appropriate for ordinary American families. You all have been incredibly supportive in that work, and I have to tell you, in all 3 of the areas I just described, a market structure that makes sense for long-term investors, in corporate rules and governance that make sense for the long-term American family and retirees that you're protecting, and in terms of the products that get marketed to them. Without CalPERS' help, honestly, these are areas where American investors would be much worse off. And not only those that you protect in California, but across the nation, because your voice in this building here at the SEC is heard so loudly and so clearly as someone who's a credible representative of what investors need, that you've always got my attention, and indeed everybody here at the SEC. So with that introduction and background, and with my deep gratitude for your incredibly important work, I'm happy to take your questions. I want to just make one more side note, which is that the team that you have in place on these issues right now has been absolutely extraordinary. I am very lucky to work so closely with Don Pontes and his team. They are key advisors for me on what investors need and want, and I'm delighted to have their support. Without it, I wouldn't be able to do any of the work that I just described. So with them in mind and my gratitude to them, I'm happy to take any questions you all might have.
Yeah, thank you, Commissioner Jackson, for joining us. We're grateful for your perspective from inside the administration and for the work you've done to improve transparency around corporate governance. So we'll take questions, Ms. Yee.
Thank you, Mr. President. Thank you, Commissioner Jackson, and it's really wonderful to have you join us. And I think this might be the first SEC kind of update we've had since the change of the administration, so I really appreciate the comprehensiveness of the issues you're covering. I wanted to see if I could drill down on a couple of things, because there were, I think, several policy issues that were in flux prior to this incoming administration. And that is with respect to the SEC's review of proxy advisors. And I don't know if there are any regulations that you're anticipating that would fundamentally alter the relationship between proxy advisors and their clients.
Well, thank you very much for the opportunity to talk about that. The SEC held a roundtable on this subject in November, and I'm happy to say that many important players, including you all and your team from CalPERS, were in the room and around the table as we debated proxy advisors and their future. Let me say 3 things about that. First of all, the clear consensus around that table was that we at the SEC have a lot of work to do in the basic voting infrastructure at American companies when it comes to elections. So right now, for example, if you cast a vote in an American corporate election, you all, who represent so many billions of dollars, so many millions of people, if you cast a vote in an American election, you can't get a confirmation that your vote was counted. And that basic plumbing of how the votes you cast are counted needs to be fixed. And my argument has been, and I argued this at the roundtable in November, that before we start worrying about questions like who's giving advice as to who's voting for whom and why, we should make sure the votes are counted. And that's really where I expect the action to be at the SEC over the next few months. With that said, my second point is that there has been some movement, both on Capitol Hill and here on the SEC, regarding proxy advisors. And I would just point you to a bipartisan bill introduced in the Senate by Senator Reid regarding proxy advisors, and in particular, the prospect that they register as investment advisors. There's some movement in that direction. ISS, the largest proxy advisor, is already registered with the SEC. Glass Lewis, the second largest, used to register with us. I don't think this would be a significant sea change, but for those who are worried about their influence, I think this might be comforting that as givers of investment advice, they might have to register with us as investment advisors. And then finally, let me say that I know, and you all know, that there's a fundamental mistake being made in this debate, which is that ISS and proxy advisors have too much influence for the taste of certain corporate insiders. And the reason you and I know this is a mistake is that, of course, investors like you take the advice you get from ISS and Glass Lewis seriously. But the idea that anybody, in particular investors as active and thoughtful and engaged as you all, just shop out your vote to them, it's just not how corporate governance works, and anyone who's spent any time in a boardroom or thinking about these issues knows that. What I have said, and what I hope will carry the day here at the Commission, is that people are viewing correlation and confusing it for causation. That is, they see that when ISS recommends a no vote, many investors like you also tend to vote no. But it doesn't follow, of course, that your no vote is caused by ISS's recommendation. No. Instead, what's happening is both you and ISS, usually you first, by the way, have identified a problem at a company and have concluded that you might want to vote no. I fundamentally think that those who have been pushing for changes in this area realize that the problem that they want to solve, to the degree there's a problem, is not a problem with ISS or Glass Lewis. It's a problem about how we want to hold corporations accountable. And that's why I don't expect there to be significant changes in this area far beyond the bill that's already been introduced. More importantly, I think all of you sitting around the table can contribute to this debate right now by making clear, as you already have, and I hope you'll continue to do, that you vote your own conscience. You vote the interests of the people you represent, like every significant investor in America. And I think making that message loud and clear for the next 6 months might be important to this policy debate.
That's great. Thank you. And then just one other question. What do you see coming down the pike with respect to any rules on executive comp, particularly any rules that address the clawback of executive comp, and then the pay for performance assessments by investors?
Sure, both good questions. When I was confirmed, I called on the chairman of the SEC, Jay Clayton, to commit publicly to finish the executive compensation rules under Dodd-Frank. I'm very happy to say that shortly after I was confirmed, he publicly agreed to finish those rules. And just a month ago, right before the shutdown, we finished a final rule on disclosure of executive hedging. That is, the executive's tendency to make bets against the company's stock to weaken the pay performance link when they get paid in stock. So I'm proud that we're finished with that rule, and again, we did that unanimously. On clawbacks and pay performance, I'm hopeful that those are going to be at the top of the agenda over the coming year. Now, the crucial part for me is not so much when we get them done, although I agree with you, that's very important, but it's very important that we get them done right. And particularly with respect to clawbacks, we need to have a very firm and clear clawback policy like the one Congress envisioned in Dodd-Frank. I've been pushing for that, and I'm hopeful that it's something we'll complete during this calendar year. But this is the part where I have to say, unfortunately, that a lot of this depends on when we resolve this shutdown. I know you all know too well that you don't flip the switch and turn on the machinery of a government like ours. It will take considerable time for us to come back up to speed, including our rule writing teams. And I've begun to get concerned that our progress might be slowed by the length of the shutdown.
Okay. Ms. Brown?
Thank you, President Jones. Commissioner Jackson, last year the SEC proposed revisions to whistleblower rules that many see as weakening incentives for people to come forward with information about securities fraud. The changes include caps on awards and makes it more difficult to collect an award if the information provided is not from inside information. I think we all support the rule of whistleblowers in protecting the integrity of financial markets, and I was wondering if you could provide us an update on the SEC's implementation of the proposed revisions.
Thanks very much for that question. It is a very, very important issue, and I'm glad you've raised it. I dissented from that proposal a few months ago for exactly the reasons you've mentioned. The whistleblower program under Dodd-Frank is one of the most extraordinary success stories in the history of the Securities and Exchange Commission. And it makes good sense that if you're asking someone to give up their career, their reputation, their livelihood to bring fraud to light, you have to have some hope of compensating them. And the more uncertain you make the compensation, the less likely people are going to be to come forward. And again, this is an area where your organization has done incredibly important advocacy. I and Commissioner Stein, who was then with me on the commission, dissented from that proposal very forcefully, and we've been fighting inside the SEC to encourage the chairman not to put caps on awards and understand that the less compensation you make available for whistleblowers, the less whistleblowing you'll get. This, to me, is just very basic economics. Now, I do want to say one more thing for your consideration. We've had a number of unfavorable decisions from the Supreme Court of the United States in their interpretation of the whistleblower statute. In particular, one recent interpretation makes very clear that whistleblowers who first report the fraud internally may not be eligible, and indeed many cases will not be eligible for whistleblower awards. I'm beginning to feel like, and I'd be interested in your views, that the construction of this statute has become so narrow that we may eventually need a legislative solution to make clear what Congress really meant, or rather that Congress meant what it said when they enacted that statute. So I would pay attention in two areas over the coming 12 months in the whistleblower area. First is to see whether or not the chairman moves forward with his effort to cap awards. I certainly hope he will not, and if he does, he won't have my support. And second, to see whether the new House majority chooses, and in particular the Financial Services Committee, chooses to impose a legislative fix that would remove caps on awards and also encourage employees to come forward to help us discover fraud.
Thank you very much, Commissioner.
Okay.
Thank you.
Mrs. Taylor?
Thank you, Commissioner. I appreciate you appearing before us. Wish you could be here. A couple of questions I had was, I believe in the beginning of the administration, the disclosure of executive pay packages was rolled back. So how do we work on that so that we can, as you said, that's one of the issues that we find very important. It works to help our beneficiaries. So how do we, if we're not getting the data, how do we work on that together? And is there a way that the SEC is going to enforce that? And then the other question I had was on ESG, and I know that the IOSCO published a statement basically stating that they feel that we should have full, accurate, and timely disclosure of financial results, risks, and other information that is material to investors' decisions, and that while ESG issues might be considered non-financial issues, they do still have long-term and short-term impacts on our risk management and our investment returns. So could you answer to that as well? Thank you.
Well, thank you, and I believe me, I wish I could be there with you too. Your weather's a lot better, so I really I'm sorry I can't be there with you. I want to answer those two questions in turn. First, you're absolutely right that at the start of the Trump administration, the then acting chairman Michael Pivovar rolled back several important disclosure rules on the executive compensation front. I'm very happy to say that that the new chairman, the the actual chairman, Jay Clayton, has not taken those steps and indeed has moved forward executive compensation disclosure rules like the one I mentioned on hedging a few minutes ago. You are absolutely right that CalPERS has been, I think, the national leader, frankly, in moving these issues forward. And I think it makes good sense. And here's what I want to suggest to you as something to think about. Your colleague asked about the pay performance disclosure, and I'm especially interested, being here at the SEC, in requiring more disclosure regarding executives' incentives to manage for the long term. My concern is that stock-based compensation is giving a lot of executives reasons to do short-term things that don't make sense. And in fact, I gave a speech about a similar subject a little less than a year ago about stock buybacks, where I observed that most companies that announce stock buybacks, on the day of the buyback, executives sell shares that they were granted as compensation. And I argued in that speech that whatever one thinks about buybacks, and it's a subject on which there are many views, nobody should believe that executives should be able to sell their shares at the moment where the stock pops, taking advantage of a short-term stock price spike, rather than manage the company over the long term. So that's an area that I plan to push forward over the coming months, and I'm hopeful. I look forward to working with CalPERS and its team. This is an area where I think we need a lot more transparency. I think if a corporate executive is going to use a buyback as a moment to sell their stock, they should have to disclose that to the world. I'm happy to talk more about that with you and your team. With respect to the IOSCO statement you mentioned regarding ESG, I saw that, and I thought it was a really important step forward. This is another area where CalPERS has been extraordinary in, and again, I want to be clear, in moving forward not a particular agenda, but the long-term interests of investors. The ESG statement you just mentioned talks about, as you say, and I think you put it just right, talks about the need for companies to have a long-term strategic plan regarding ESG risk. And this isn't a particular point of view about the subject of the environment. This is a point of view about a company's responsibility to grapple with the risks we all face, and sadly, those risks today include environmental risks. Now, I want to point out something that's notable, which is that IOSCO as an organization over the years has formulated those policy statements without endorsement by any particular agency. And indeed, as was noted in that statement, we at the SEC did not endorse or disagree with that particular statement. I was disappointed by that because I think we should endorse a statement like that. And moreover, I want to point out that there was a petition filed here at the SEC in the fall requesting that we develop new disclosure rules regarding ESG disclosure. And I'm of the view that it might be time for us to take a careful look at that petition, in particular, because I have the sense that investors like you care about this. And one of the things that you've been so helpful with, and I want to urge you to continue to do, is that I've got colleagues here at the SEC who would respond to the interest in environmental or social disclosure, who would say, these things are not material. They're not important to investors. And every time all of you representing billions of dollars come forward to say what's important to investors, you give me an argument, a basis to say, no, this is material. And I know that it is because those who manage money on behalf of millions of families say so. So that's one other way in which your work has been so important to me, and why I'm so happy to have the chance to talk to you today.
Okay. Seeing no further questions, we want to thank you, Commissioner Jackson, for joining us today, and we are grateful for your perspectives from inside the administration and the work that you're doing to improve the transparency around corporate governance. So again, thank you very much for your time, and stay warm.
Well, thank you so much, sir. I so appreciate it, and I hope we'll be able to continue this conversation over the coming years.
Okay, how about a hand for Jack, Commissioner? Thank you. Okay, now we're running on good time. How about comments from Karen about housekeeping?
Thank you. We are going to take a break for lunch now. We were going to return here at 1 o'clock to continue our investment discussions with a panel presentation about the global economy and market valuations.
Okay.
Thank you.
See you at 1 o'clock.